Countdown. Okay, are we live? Did we make it?
We're live.
I think so.
Look at that. For the first time ever, a real estate investor figured out how to use something with technology. I mean, like that is definitely a first. So welcome everybody. So excited that you're here joining us today for the TEM Capital webinar, going over this incredible self-storage deal with my good friend and partner, AJ Osborne. Before we get it kicked off, I just want to let everybody know I found out I'm having a boy yesterday, so I'm on top of the world today. Super excited. And, the biggest motivating factor that got me investing in real estate was my family. So for me, real estate is here to take care of my family today, tomorrow, and for generations to come. And, I don't know how much you guys know about me. You might have seen me on my TV shows on HGTV, Flip or Flop, or Flipping 101, or my newest show, The Flipping El Musas. But I'm just a passionate real estate investor, and everything I have today came from real estate investing. So I want to introduce, like I said, my friend and our very special guest and partner, AJ Osborne. Listen, you guys see me on TV. You might be a fan of me, but AJ, I'm a fan of him. This guy is the self-storage rock star. I'm telling you, of every single human on this planet, this is the guy that we decided to partner with because his track record is out of this world. And AJ, why don't you tell everybody a little bit about yourself, what you've done, and then we'll kick this thing off.
Yeah, I'd be happy to. I've been in self-storage for too long. So I'm in self-storage when before my now 14-year-old girl was even born. So we're going on 16 plus years, and it's an industry that I love. And when we were in it, so when we actually got started in self-storage, nobody talked about storage. Banks wouldn't even loan. It was kind of this asset that was kind of a thing on the side. It was the newest real estate asset class in the United States. Well, this little thing on the side outperformed every single commercial real estate asset for 26 years. That's across how many recessions? It's shocking. And what they didn't understand, they found to be the most resilient and profitable commercial real estate asset. And that has to do with a few things, including really, really simple things, right? Like the fact that in our economy, it's easier to buy things and it's cheaper, and yet it's getting more expensive to do real estate. And these were things that we pinpointed right out of the gate. We didn't understand why banks or other people thought it was a risky asset class. And it was just because they didn't understand it. This gave us a huge advantage because we were so early in the industry that we actually have been a big part of infrastructure in the industry. So we started up the largest self-storage co-op in the world. It has I think it's 1,500 self-storage facilities and operators, which it is now bigger than all the REITs except two. And we have our own technology company that's a property management system. And we're fully integrated. We do everything. We manage, we operate, we syndicate, we partner, we build, we convert. We've really done it all. And when it comes to real estate investing, we're not really real estate investors. We're just storage people, right? I don't do anything else. It's just storage. And our whole business, we have over 80 employees, is all built around and predicated on self-storage and its business model. That's all we do every day is we find opportunities, we close on it, and we extract yield out of it. We cut our teeth doing value add. From there, we moved into development. And then from there, we moved into conversions like bankrupt super Kmart's, office buildings. Yep. And we built out all our team and everything around this amazing asset class. The reason being for us was I needed yield and I needed to affect yield. Most people, when they think of real estate, they think the market, right? So the market makes you rich in real estate, which is true. And that's amazing. For us, though, I was a business guy, not a real estate guy. I was like, I have to affect the asset. So we became really good at buying and optimizing and running these storage facilities and getting huge profit margins and making them extraordinarily profitable.
So yeah. Pretty much you are to self-storage what I am to flipping houses.
100%. Yeah, exactly. Yeah. I wrote the best-selling book in the industry. I have the largest podcast in the industry. We've been teaching about this asset class for a long time. We owned it through the Great Recession. We bought, and we think it's a vastly misunderstood asset class. But now everybody understands these things are kind of cash cows.
Okay, awesome. So, guys, I am so excited about this deal. I can't wait to start going through the deck. So I think we're going to do that right now. But there's one thing that's really, really cool that we put together. And AJ, if we can make sure we cover this. Well, one thing that's important, in order to partner with us on this deal, you do have to be an accredited investor. The investment minimum is $100,000. So AJ is actually going to show you what it would look like if you put $100,000 into this project. So it's going to be an example of what a $100,000 investment looks like. So I'll let AJ kick it off.
Yeah, first, though, I do have to admit something embarrassing. This picture, I'm wearing the exact same shirt in the picture. How does that even happen? I swear I changed my shirt. Not normal. I saw that and I was like, wait a second. Funny enough. Yeah, we really like to look at a lot of these investments, as we're going through the deck here. Obviously, you guys know Tark, you guys know his team. They're amazing. It's seriously, I was so impressed with Tark when I met him. I thought, I don't know, maybe it was just, okay, you're kind of a movie star, you're a television star. And the absolute just grit and drive and what you do, dude. It's
Thank you.
Crazy.
Hey, you too, man. I had so much fun hanging out and hearing your stories and talking real estate. It's not often you find people as passionate as us. So, we both believe real estate's a gift, and we just want to share that gift with the world.
100%. We're both lucky enough to have partners in this deal, which I want to talk about these partners. So it's Barry Goldwater and Ken. And yes, it is the Barry Goldwater. So his father was a senator. He was a congressman. And they actually brought this deal to me and Tark. And the reason that a lot of the advantages that is going to come with this deal is because of Barry. So they were able to negotiate and streamline and expedite with the government the process of development. I have 2 developments right now that we are over a year and a half, and we don't have permits. We don't have anything. Well, this development, we're streamlined to do in like 6 months have permits, which for anyone that has done development, especially commercial development, knows that's just unheard of. And it's pretty amazing. So we've got
and AJ. So sorry, you know me. I just like to talk. So you think we're going to be getting the permits in about 6 months, and typically to get permits on something like this, it takes 2 years. So that's why he had our partner Barry Goldwater up on the screen there, because he's helping us expedite that process. So it's a huge advantage to everyone investing in this deal.
100%. And for anybody that's been in real estate, but especially commercial real estate, you guys know it really is the teams that make these come about. And that's why we're so lucky. Okay, you already know me. Here's part of our organization. We're located in this. This is even a little outdated, but we're located in something like 10 plus states across the United States. We have over 2.5 million square feet. Right now, we have another 1.5 million square feet under contract, and we also have another 850,000 square feet under development. So for people that don't understand square feet, because that's how we talk about it in self-storage, it's like 10,000 plus doors. So that's a way to think about it.
So that's a lot of doors. Wait, how many square feet did you have again? Let me see that again.
Yeah, so we have over 2.5 million square feet. Yep.
That is
with
wild.
Another 1.5 under contract right now.
So I would think you know what you're doing by now, huh?
Yeah, we hope so. We definitely hope so. When we've looked at kind of our experience and what we've done, I think it's really important, some things that separate us as operators. And the first is that we did not build our company with investors. It was 100% me and my partner, who was my father, and we reinvested all of our money. And why I think that's important to know is we took 100% of all risk for over a decade. We hired our entire employee base. Our company is self-sufficient, and it does not need investors to survive. Investors allow us to do more, and it allows us to spread the profit and opportunity out. But we have been doing this since before the Great Recession, and we've taken all the risk. And we waited until we really knew what we were doing to bring outside capital in. So it creates a very unique history. We've never lost a deal. We've never gone bankrupt. We have a lot of other deals that we can show you, but we don't have a deal that we've ever done under a 200% return at like a minimum. That's including new deals that we've just done. And that doesn't include selling the deal. That's really important to understand. And I'm going to talk about that in a little while, because it's one of the, our strategy is one that I've never seen in self-storage. We're one of the only people that do it. And it has to do with our past. And that strategy is outrageously beneficial to investors. So it's pretty exciting. First, to talk about this deal. Tarek was right as he talked about this deal and how exciting it is. For me, doing this is one of the most exciting deals we've ever done. It was a deal that was brought to me and Tarek, and it's a deal that I'm still in awe at the location and how good it is. And, you know, it's one of the deals that it's just a rock star, and we're really excited about it. At the end of the day, let me kind of walk you through how it all is going to work, what it is. It is over 200,000 net rentable square feet, comprised of two functions: indoor climate controlled and drive up enclosed RV storage. The purchase price that we had at the land was $10 a square foot, which we purchased. So that's our money we've risked. And it's worth over 15. The lot in the same thing is selling for today 20 square feet per capita. So that's literally double on our money without even doing or building anything. And that has to do with the location is such an incredible location, which we'll get to. How our strategy works is we have investors come in, and it is really, you know, you got Tarek and me that do all the work, but we give an 8% preferred return to the investors. So we make sure that they're getting an 8% preferred return before there's any splits or anything else like that. After that, it's a 70-30 split, which means 70% to the investors. After they've gotten 8% and the 70%, then we get 30% on those profits. We do a projected payback period in 3 to 5 years with a 20% return. Now, that doesn't mean the investors leave, though. They still own the deal. And that's what we're going to talk about.
The best part.
That's the best part.
That's the best part. That is my favorite part.
Yes. And we'll show you how it works to understand it with an investment. So let's say that you're like, well, if I invested $100,000, how would the numbers work? I'm going to show you that. So we're going to get into it. So it'll be easy for you to really understand how this investment strategy works. Now, first, the location. Our location is in an area called Surprise, Arizona. It is in the Phoenix metro area. It is one of the fastest growing cities in the entire United States, and it is being fueled even more than it already is, being one of the top fastest growing cities in the United States, by the amount of businesses that are pouring into this area, including it is one of the largest chip manufacturers in the world, is already under construction there, of which they are going to hire over 5,000 people that are going to make 150,000 plus in income. That's already under construction. It's absolutely incredible. Right now, it's growing from a population of 150,000 in the area to 15,000. They literally can't build homes fast enough. Our location is right on the freeway exit. Now, this Toll Brothers, which is 2,200 new homes, yeah, I think it's already done. So the last time I was out there, it was like 80+% done filling the homes. They do not allow RVs. So there's no RV, boat, anything else like that is allowed in their area. The Toll Brothers told us it's their number one request is where to put RVs. Now, to top that off, our location is right next to two RV sales companies that are being built right now.
So,
and yeah, go ahead.
Sorry, AJ. So this was my favorite part of it when he explained it to me. He goes, you know, like in California, you guys have these big old houses and these tiny little garages. I'm like, yes, I do. He goes, well, they're building the California garages in Arizona now. And it's totally true. So this Toll Brothers community, they're building these big, beautiful, fancy houses with regular 2-car garages. And on top of that, the community doesn't allow RVs or boats. A lot of people living in Arizona, guess what they like to do? They like to travel with RVs and they like to go boating. So guess what? They need to store those somewhere. So do they want to drive 10 miles to go store their stuff, or do they want to drive right around the corner from their home?
Yep, exactly. And aside from that, that's just one development. This right here, this entire corner on the freeway is under development. I went out and saw it last time. All new homes, multifamily across the street. Everything around us is currently under development with homes on top of all these new homes that were put in. They're in for the whole entire area around this. If you want a storage facility, you have to go by ours to get a storage facility. And when we look at storage, we understand it is really very much demand driven. This area has one of the highest demands I have ever seen. And it is also one of the highest per square feet in revenue we have ever seen. To give you an idea, I'm developing in areas that have 15 square feet per capita, which we believe are rock star areas with strong demand. There's only 3 square feet per capita in this market. It's bonkers, the demand. So the facility, this is a large facility. It's 200 and roughly 60,000 square feet. It's 10 acres, 1,000 units, 232 RV units. One of the reasons it is so large is due to this RV space that you can see. On the map, you have the front building, which is a multi-story, 3 stories up, and I think 1 story down. We're still looking which way to go.
It's a beautiful looking building too.
It is. It's going to be just gorgeous. And then we have we have wash bays, we have pumps, things like that for the RVs, a dump on site so they can come. And then all of these are large RV enclosed units. They have their own doors, roll-ups, everything else. Here's kind of a breakdown of how we are looking at the units, the unit mix. We view self-storage as a business. We have a product and we look for product market fit. So these numbers will be changing as we do market testing, product testing, things like that, because we want to maximize the yield out of every single unit. So we don't want there to be any units that aren't very well planned and have a very, very high demand. All right, the offering on this deal, we mentioned you have a 8% preferred return. We have 70% LP shares. After a capital transaction event, which means after the investor, you gets 120%, all your money plus 20% back. Then we do a 50-50 split of the profits. So you're still in the deal. We're not getting ready. You're still in it. We just split the profits then 50-50. Distributions are quarterly. It is a 506C offering, so accredited investors only with a minimum investment of $100,000. The overall P&Ls, and when we're looking at the financials, self-storage as all assets, we have a ramp up period. Now, it's important for you to know all our numbers that we have are projected on a 3 to 4 year fill up. Okay. Now, I have never done that before. It has never taken me over a year. Never. So we are very conservative in our planning. What has taken me every single time a year to do, we're planning out almost 4x that into 4. And that markets that demand.
So, sorry, AJ, like that's one of my favorite things about partnering with you is, you are conservative. You are a real estate expert. You follow the trends in the market. You look at the absorption rates. where a lot of people, they're showing information on different properties with projecting appreciation of X% per year over the next 5 years, and nobody can predict the future. So I love the fact that you look at today's real estate and you're super conservative in your thoughts.
Yeah, 100%. And you bring up a really good point. When we look at how we're building it out and everything, we're not telling you, oh, in 5 years, we're going to get rate increases of this. No, in fact, it's the opposite. We're taking the same rate and everything as if it was today, and there was zero appreciation in the market. So if the rates continue to go up like they have been, and we can achieve those higher things, that's great, but we don't plan on it because I haven't seen it. So once it happens, which it has, to give you any idea on our portfolio, we have never had 1 year that we didn't, on average across our portfolio, give a 10+% rental rate increase. We do not plan on that at all in this. So we try to be very realistic, find a baseline. And if the numbers don't work on that, we don't, I have a saying, I don't want the market to make me, meaning the deal has to be so good that we can put it up. And if the market grows and you have appreciation, things get better, that's awesome. But that's the cherry on top. When we're looking at the returns and how the returns are based, once again, on a 4-year fill up refinance, and on keeping those rates that are in the market today, all of those types of things, which is smart and prudent, because if we have a severe recession that affects this area abnormally, or something happens that we don't know, because there's a lot of things that I don't know. So I plan on it. I call it my margin of stupidity. Warren Buffett has a margin of safety. I have a margin of stupidity, which means I can be stupid and this can still be really, really successful. And so if we keep that in mind, I know which deals we should be doing. We are very, very selective on development deals. So if you look in this scenario, you invest $100,000, right? We have a build-up phase on how the total returns are going. Within year 4, we have over 120% cumulative cash on cash. Now, our equities multiple is over 4. And the reason being is, although we've hit those targets, although you've gotten these great returns and everything, that doesn't take away your equity. So you're still making money. You still get all the increases and everything after that point. We do our equity conversion, which in our strategy, it's not a sell. So in most syndications, you get that return once those people sell that property. Now, I don't like that for 2 reasons. First, I like to own the real estate forever. We're a long-term investor, wealth creator, and builder. Second, taxes hurt you really bad in that scenario. In this, the majority of our return is tax-free because it's in the form of a loan. We also get depreciation year 1 that gives you a huge, huge tax break. So your total returns, our strategy and our plan should be tax-free. Now, that's going to depend on you, your taxing strategy, and I'm not a taxing expert, so I can't count it. That's how our strategy is set up and what we're trying to do with the numbers. So we're trying to make your return, your actual, net, as high as possible with still owning the asset, the wealth, and the income moving forward. Now, when we look at things like a low performance versus a high performance, what we're really trying to calculate here is a low performance is, let's say rates are lower, right? They went down. Let's say that we weren't able to fill up like we thought we would. Okay. And even amongst those things, we still have a great property. So, that's kind of a signal to us that's like, hey, even out of these. Now, it's also important to remember that this is a first tier market. So in this market, valuations of these assets are higher than the vast majority of the United States. First tier markets are areas like Phoenix, LA, right? You have San Francisco, New York, things like that. Investor demand is astronomically high. And that spread between what we can build at and what it's worth is very, very large. We don't depend on that because cash flow, though, makes it all work. Our profits, things we really want to focus on the cash flow, the revenue, and optimizing it. But that is a cherry on top, being that we will have a big value spread on it. High means, okay, we hit all those numbers and everything. Now, technically the high could be a lot higher than this if we get rate increases and everything up that we just don't have written in and we don't plan for. So, okay, sources of capital. Now let's talk about the money and what we're doing and how we use it. Now, this is a fluid number. This is not predicated on hard bids. So we have taken this number from what was absurdly high to more of a medium number and gone in between. Now, our numbers that we first looked at this deal and we really started to think about what we wanted or how much it would cost to do this, we were really high, like 30% higher than what it would actually take to build, due to the fact that we had unknown in price changes due to inflation, things like that. As of right now, the cost of 60%, which is all the metalworking and metal fabrication, is actually going down. So we've seen those spikes. We're off the highs and they're going down, which is great for us because that's the majority of the cost in a storage facility. So when we look at this, we need to raise, 12, we really think probably 12 to 15 million. Our acquisition loan, construction loan, and consolidation loan, and then our refinance loan. So when we're looking at the total project, how it all might work at refinance, okay, so the value of it, we think is probably around 36 million, of which we will be raising, 12 to 15. Now, the site acquisition is 4.6, which we already own. The closing cost adjustments, 177,000. Hard costs are around 30 million. So we think 25 to 30. 30 honestly is way too high, but we still look at that realm and we really want to see what it is. Hopefully it'll be even below 25, but we'll see. Operating reserves, we keep very large reserves because that fill up time, why it's not cash flowing, we want to be able to run for years without, let's say that something really bad happens in the economy, okay? And fill up just stops. Well, we'll be able to run for years with our reserves. And that's a really, really important piece to us. If we fill up in 1 year, so it's like, oh, we just filled up immediately, we don't need these reserves, we get to distribute those back in the form of profits to you guys. So it's not like we lose it or anything else, but it is that we're prepared in case anything happens. Going through 2008 and being on that end, I saw what happened when people weren't prepared for the economy to change. We don't make mistakes like that. Construction management. So we have our acquisition fee, which is $200,000, which goes to our acquisition partners. We have our construction management fee. We have our origination fees, like our loans, all that kind of stuff that goes on. And that's included also the capital transaction fee, setting those in place, setup and organizational fees. That brings the total use to $3.4 million on this project, which is, once again, it's 260,000 square feet. That's actually really good. That's better than we were seeing a year ago. Very, very exciting to see that, because a year ago our projects were really high and still going, where we planned on this project a year ago. That's when we thought it, and it worked with escalating costs. So to see all that actually going down, that's just margin for us in the business.
Yeah, and by the way, with everything that's happening in the world and the economy right now, there's a good chance by the time we go to build this thing, labor, it's going to be cheaper. Materials, they're going to be cheaper. So now we've acquired the land at a discount. When it's time to build, if we can get the construction done at a lower cost, these numbers get even better. And guys, you saw what he just showed. This is the type of real estate you want to own. It's beautiful. It's brand new. It has an exciting location, high demand, and it's a trophy asset. And by me personally, man, I'm just so excited about it.
Yeah, this will be one of our premier assets. This is going to be an asset that, I built several of these that ended up becoming white papers, and industry talks about it. I think even one of our properties was in the Wall Street Journal. And this is another one of those. And it's honestly one of the reasons that our firm has gotten known. And what we've done is we were able to create these outrageously profitable assets in these kind of markets. So when you look at our overall down payment, right, we're looking at interest on the loan amortization. There's a few things that we consider and we look at. Now, in our interest rate environment that we're in, it's very different than the housing market. So for commercial real estate, interest is not the same. So like an interest on a house, maybe 6%, we're not getting 6%. That's much higher. We just got quoted, I think it was 4.8 to 5.2 on a property. But one of the things that we're doing and to hedge with our financial partners is we put a good amount down. So we're putting 35% down. This does two things. First of all, it gives us excellent terms on our loan. So we can negotiate things like interest only, which we don't we're really, when we look at these things, how it's going to work, we put 12 months, which is pretty standard. We get that at a time. Honestly, we're going to probably get way more than that. But we just allocate that for one. We'll probably get 3 years worth of that. But that gives us a nice buffer. It gives us great terms and great interest rates that are not this, but we do up it because interest rates can and probably will go up. So we actually expect that to happen. We're planning on it. And our refinance period, when we look at it, we're planning on that interest rates being up, which is funny, though, because once we refinance, we actually get even lower interest rates because we can collateralize the debt. So we can not use like a traditional bank, but we can actually sell it on the bond market and we can get much, much lower debt. We still plan on, we're 2.5 points higher than we can get today. So we're conservative on the interest rates because there's no reason not to be, right? If it's lower, that's just good. That just means we have more cash flow, everything else. All right. That's a lot of information I've ran through here. Tark, do you have questions or things you would like me to touch on before I can go back to the 100,000 and talk about that process too. I really want to hit on that.
Yeah, sure. I mean, the biggest things that stand out to me, is one, the land has already been acquired and the land's already appreciated, right?
Yes.
Two, right outside of our self-storage development, there's a brand new Toll Brothers community that doesn't allow boats, doesn't allow RVs. Three, they're building 2 new RV dealers right outside of our self-storage community. So, I like this deal for so many different reasons. And then when it comes to the 100,000, to simplify things, an investor is going to put $100,000 in a few years. Once it's developed, a refinance is going to take place. They're going to get 120% of their investment back. From that point on, they still own the asset. We just got a higher loan, so we were able to pay back their investment. And then moving forward for the rest of time, as the years go on with inflation and everything else, the rents are going to go up. When the appreciation happens, if the value goes up, we're going to refinance again and again and again. And every time you do, you're going to get your percentage of profit back. So this thing is going to keep paying and paying and paying. And I don't know if you guys saw my social media post this morning, but I seriously, I was thinking about this last night. Like, I am ready to get as many people as humanly possible together, and I'm ready to wage a war against inflation. Inflation has stolen almost 10% of all of our cash in the last 12 months. And this is how we do it. We do it by buying assets just like this. And, before I became a passive real estate investor, I have an expensive lifestyle. I have nice houses, nice cars, go on nice vacations. A few years ago, I realized, man, that the day I stopped working, well, I can't pay for my house. I can't pay for my cars. I can't pay for these vacations. So what did I do? I started thinking about tomorrow. So if you're out there and you have some money saved and you're thinking about your future, man, think about investing in this deal because this is one of the great ones.
Yeah, I want to hit on a couple things here. I may even, do something here a little.
Sure.
Would you mind if I shared my screen here? I kind of want to. Let me see if I can make sure that I can actually do
sure.
this. Because I think this is cool. This everybody kind of going to what, kind of going to what Tarek's talking about, we got this location, and you can see the screen now, right?
Yep.
So this location, you can see that blue dot. You take that blue dot to the corner. That is our asset that we're building. Now, you can see below the blue dot, there's all those farm fields, right? That's not farm fields. Those are all houses. So
Wow.
that entire thing has been built out so fast. Now, when we look at this market, you're talking about 20,000 people, okay? Now, this market right now has an average household income of $100,000. The population growth is one of the fastest in the nations at almost 3%. And as we go out from it, it gets even more and more and more, and we can do it. But this whole area, if we go to, a 4 or 3 mile radius, that's what we look at when we're looking at these types of investments. Now, this is probably a lot of information, but I just want to point it out because it is, when you're looking at these investments and the impact, so much of it is dependent on the market. As of right now, there looks to be like we have a couple other storage facilities that are being built. We've already contacted the city, and the city has let us know that they're not permitted, they're not construction. We don't even know if they're even going to go through now. They're definitely not going to be done anytime when we are. The current ones that are existing, there's no vacancy in the market. But at its current point today, in a market like this, when you look at a radius number that is within our area of impact, meaning everybody comes within that certain radius, we could essentially double the square footage on this market and we would still have demand. That's how low demand it is. And in a market like this, in this location, I shut off the slideshow. Sorry about that. I don't know if we can.
But maybe Abby, you can put up the very last slide so they know what to do next.
Yeah.
Yes. Everyone should see that on the right-hand side. There's an offer. It says invest with us. That'll take you right to our investor portal. So you can go right in there. All the documents will be in there. Additional information for how to complete your investment. And we can get to a couple questions that came in.
Yes.
Sure.
Just around, the timeline. So when is construction expected to be completed?
So this is a great question. Now, we all know how development is in construction. At the end of the day, we hope to have approvals and everything by the end of the year. But it should be known that we've been working on this for a year. We already have, as you saw, architects, designs. We already have all parties that are already contracted and moving forward on this deal. And that's one of the things about with my firm and working doing, we do the deals anyways. So whether we have investors or not, we've been working on this deal to put this deal out. So with that said, they're ready to go. All of them, the builder, the architects, the manufacturer, the largest manufacturer in the world of self-storage metal and material is a block down the road. Their manufacturing plant is literally, I think it's 1.5 miles down the road from our location. So we joked as I was in their location. I'm like, so you're just going to send it out. I can get my truck and just go pick it up and run it down the road. Right. So we have a lot of things going for us that can really expedite and make this thing go fast. It usually takes a year. So a year to build. So if we're looking at today, 1.5 years to be up, running, operational, which in the world of commercial real estate is lightning.
Yeah. And right now, I think we just announced this project last week. We have quite a few commitments already, filling up pretty quickly, obviously, because it's such a wonderful deal. So if you guys are accredited, you are interested, go ahead and go to the InvestNext portal. It's right there on the right side of the screen. And then also, if we talk too fast and you still have more questions, let us know. And Abby, what's the best way to have them reach out to you with further questions?
Yes, so you can reach out to me directly. My email is abigail@tmcapital.co. I'm going to put that right here in the chat as well. So if you have additional questions after registering and taking a look at the portal, please feel free to reach out to me directly. So there's my email, and I'm happy to help with any questions.
I will mention one thing here, everybody. Tark's got this deal for you guys that you guys have first shot at. Meaning, I'm not going to my people, anything else like that. That will change obviously here soon, because the question is there a cap on the number of investors or investment that they can put? And the answer is yes, we will cap out. And I can tell you now, we've given this time, obviously, for them to put their investors in and everything, because this is a deal that it's going to go fast. So I just got to preface that so you guys aren't in it and you're saying, well, I wanted to get in it, and then already by next week, you guys didn't have your commitment in, and Tark's like, sorry, I don't know what to do. It's gone. It's filled up. So I just want to make sure that we put that. You got your time. We are giving it to him and his group and everything, but it's going to go fast. So don't have an expectation that we're going to be doing this for like 2 months or anything. I've had people get mad at me. Like, I thought you said I could. I'm like, look, you could have 3 weeks ago.
Yeah, we just got to move fast. So I do have a question. So I know the minimum investment for our deal is $100,000. What's our maximum?
So that's a great question. Normally speaking, our maximum is 20% of the amount needed to be raised. So generally speaking, it's probably going to be around 3 million. And the reason is not because we care. It's because the bank will change the way the loan documents work. So if you come in and you have over 20% of the money in, the bank's most likely going to say you have to be on the loan. And so they won't allow you to. So normally we have it structured at 20%. If there's more, so if you had somebody that said, hey, I'll just give a full 5 million, we can talk with the bank and negotiate that out. But I think as a rule of thumb, it's probably going to be, 3-4 million.
Okay, perfect. And with the investment, the investors they'll put their capital in, and once the project's developed, the refinance take place, then they get all the investment plus 20% back. And then moving forward, the development's done, all the units are occupied. How often are the investors going to be getting the distributions?
Quarterly. So we do all distributions, financial information is all done, reported quarterly. We also get all the tax information, everything like that done. We use third parties, and this is important to know. Tark does as well. The Invest Next, to take your money in, you're not sending checks to me or these guys. That's not how this works, right? We don't want you to. Right? That's not anything we want. You send it to a third party, who that third party has all the legal documents. They issue out the shares for the money that goes in that is given to another third party. It's not coming into any of our bank accounts, anything like that. From there, they also get the profit and they distribute the profit. And they do that quarterly. And we work with the third parties, like our accounting firms, that will handle all of the tax stuff as well, that they will be issued out for you guys. Now, financials, we have our own accounting department, so we can run financials, get them out, and then they are verified and checked by a third party and issued to you guys quarterly.
Okay, awesome. Well, I had a great time chatting, and I'm sure everyone else did as well, but I wanted to say thank you, everybody, for joining us. We are just super excited with this deal, and let's wage the war against inflation together. Let's buy this incredible trophy asset, and we would love to work with you. And outside of that, once you come into our group and start working with us, we have a lot of fun things planned. We're looking to do investor dinners, investor events, investor vacations. So we're really trying to create a happy, fun investing community. So I hope to see you there. See you guys. Bye. Thank you.